Welcome to the Gray Report. I'm your host, Spencer Gray, joined by Director in Communications and Marketing at Gray Capital, Matt Bosnagel. If you're a real estate investor, you're an aspiring investor, or you are in the real estate industry, you're in the right spot, because every week on the Gray Report, we are tackling all the latest research reports, data points, articles, and opinions that come out related to the multifamily industry, real estate, and the economy. We've got a lot of good reports. Again, the economy's crazy. We've got a war in Ukraine going on. We've got crazy gas prices. But reports from Market Watch, Marcus and Millichap, RealPage, and Yardi, as well as just opinions from Matt and I and others. Let's get into it. Well, I apologize. Our office dog, Tuvok, is walking around the Gray Capital studio, hopefully not going to distract us too much. He's taking a little walk of shame right now. But Matt, how the hell you doing, man?
Pretty good. You know, it's getting warm. It's really nice. I know that it's going to flip and be freezing, but I think that it's like kind of the literary term is pathetic fallacy. Volatile weather, volatile economy.
That's why we bring Dr. Bosnagel on every week for that good literary verbiage that no one understands. I appreciate that. No, it is beautiful weather out right now. I was on a podcast earlier this morning talking about green shoots as an analogy, but it's nice to see some literal green shoots popping out of the earth. Makes us all feel a little bit better, especially if you're in a semi-cold weather climate like we are here in Indianapolis. We're kind of middle of the road. It's not cold all the time, but a little bit of a gray winter. Happy for spring. Matt, we've got inflation. I mean, oil was $130 like yesterday. Now it's in correction territory. Nickel's up something nuts, and then rents continue to rise. Demand for residential real estate, continues to be strong, but we are in uncharted territory, to say the least. And, while we did not start the Gray Report to help explain uncharted territory, we did we started the Gray Report really originating as a newsletter, which you can sign up for at graycapitalllc.com/newsletter. We did it just to make sure that we were on top of the market, just seeing where things were going, and also to help others, investors, just people who are interested, get access to some of these research reports, because like we discovered this morning, again, they're just not always disseminated that well. And it's like, we've got like a Yardi report that I got emailed, but you didn't see, that's not on their website. And I just remember seeing these great reports. I'm like, I missed this report. It came out 3 months ago, but if I had this information, maybe I could have made a decision differently back then.
Well, and sometimes they'll post a report and then they will take it down like a couple days later.
It's fascinating.
Stay up to date.
Stay up to date. That's why we've got a whole team covering it. First, headline again. We're talking about inflation. The reason why we're talking about inflation, obviously, because it affects the economy so many different ways, from individuals to producers. The producer price index came out from the Bureau of Labor and Statistics just a couple days ago. We've got 10% PPI year over year.
Yeah.
That's insane. And I did a presentation over the weekend about risk factors for the multifamily industry, and inflation wasn't on that list, because inflation is a driver for real estate and real assets. Really, deflation is the enemy. So it's net mostly positive for multifamily, but there's so much disruptions in the economy. What we're always concerned about is what are the second and third order effects that maybe cause a recession, a downturn in the economy. And so we got to watch it. But what's new? What are you seeing in terms of the inflation watch?
This was a week where I really started thinking about inflation a lot, where I was like, okay, things are getting serious. And in a way that, it was already overdetermined. It was already going to be deflationary. Or inflationary, I'm sorry. And this week, things just seem to be compounding. Now, this Market Watch article talks about wholesale inflation surging to 10%. That's the producer price index. And it says, the article title says that there's a silver lining to this inflation indicator, which that's the clickbait that made me find out. They say that their silver lining is core PPI, that is inflation if you exclude food and energy prices, basically. And that inflation, core inflation, did not increase as much as PPI as a whole.
Year over year.
Yeah, year over year. Yeah. And depending on what chart you're using, I have a Fred chart that I've pulled up that shows that it went down 0.2%. The Market Watch calculation has it up 0.2%. But either way, however you slice it, it did not increase as much as PPI as a whole. And you can see why they say that the Fed prefers core PPI as opposed to just PPI that includes food and energy, because once you include food and energy, that graph gets wild. It's all over the place.
Even though, and we were talking about this before, we understand why the Fed uses it, because it's like you remove the volatility, so it makes them less needing to make knee-jerk reactions based on short-term volatility. But you're also not looking at the full, actual higher frequency picture of what inflation it looks like.
Yeah, people still paying for gas. They're still paying. They have to pay for food.
Exactly. I mean, those are two essentially inelastic parts of the economy. I mean, you got to drive to work. You may not go on a vacation. You may not buy a new fancy pair of jeans or whatever it may be, but you're gonna have to get to work, and you have to have a place to live. And you have to eat something. Maybe not a fancy restaurant, but you have to eat something. And so a lot of inelasticity on those that aren't being included.
Yeah, I agree. And I've mentioned before, and you've kind of heard us before, we talked about inflation before. We talked about it last year. I don't usually bang the drum, and we've said, inflation just is. We are far more interested in what you do about inflation than inflation itself. So kind of with this in mind, I'm going to have to darken the silver lining a little bit, because this past week, I've really been thinking a lot about inflation, especially how it might affect the multifamily market. Yeah. Firstly, even acknowledging again that core PPI is good for the Fed. Like you said, it's a big part of people's lives. It's a big part of the economy. You kind of can't eliminate it from inflation, because it's just a necessity. Secondly, core PPI still has a ways to go before it even comes close to approaching historical levels of inflation. Right now, the core numbers are at 8.36. So prices for producers are 8.36 higher than they were last year. So still got there's a lot. It's still high. Yeah. It may not have increased that much, but it's still very high. And in the 10 years before February 2021, the highest this number got was 2.9%, which happened once in August 2021 and once in December 2018. That's it. That's as high as it got. And now we're at 8. We're way higher than 2.9%. We're at 8.36%. And then just to continue with this comparison of PPI, CPI, all these things, I included CPI on this graph, which on YouTube you can see it represented by a red line, which looks a lot more stable than PPI. I can't find a really perfect correlation between the two here. Sometimes CPI seems to move ahead. Sometimes it seems to move behind CPI. But it definitely looks like the producer price index takes a lot wilder swings.
Well, in the producer price index in general, it's typically considered to be a leading indicator, and CPI is a lagging indicator.
Yeah, and that makes sense. Yeah. The producers pay for it, then you pay for it.
Yeah, the inputs. But
and then I was still even looking. It's like it's not that perfect. No. And if anything, it's like it just shows how much more stable the CPI is. There are some times when the PPI goes up huge spikes, and you don't really see that, and it means that really, they're not charging that much more for stuff. Sometimes I guess the producers are really losing money because their inputs are so much more expensive.
So what you're saying, Matt?
No, I'm not. Oh man, now I'm getting in trouble.
So what you're saying, Matt, is what your assertion is from what Joe Biden. So Joe Biden's saying it's the greedy corporations, and now it's Putin's fault. But what you're saying, it's not greedy corporations. It's probably not Putin. Maybe just the economy.
I'm only looking at lines on a page, but it does seem like there are times when the producer prices are way high, and you're not seeing the consumer prices get the same. So however you slice it, maybe corporations still find a way to be profitable. But
how dare they?
Yeah, but
how dare they make money?
But the upshot is I think that it definitely seems more reactionary and more volatile. You can see a lot more wild swings with PPI versus CPI.
Yep.
And again, like I said, all this is lines on a page. what really has moved me, and especially in this past week, are the kind of factors, the more like qualitative narrative, these trends that are compounding, multiplying, accelerating, whatever. Everything that's going into inflation seems like it's just adding to each other. You've got these economies emerging from, and let me know if I'm missing anything.
Yeah.
So you got economies emerging from pandemic with pent up demand, material shortages due to uneven recoveries and impacts of the pandemic alongside logistical delays, labor shortages that are driving burgeoning wage increases, relatively loose monetary policy from the Fed, even factoring in the Fed's plan to curb asset production and increase rates. It's still relatively loose.
Which that's supposed to be happening, to be announced today, 25 basis points.
But then there's the still present effects of government spending as the money from last year's infrastructure bill makes its way into the economy, which is going to still keep happening. And then there's the undeniable effect of the war in Ukraine. I think that all of these together really make inflation really hard to ignore.
Yeah, I mean, there was relatively high, moderate to high inflation forecast prior to the war in Ukraine, Russia's invasion. And now, defense spending isn't going to go down. And not just the United States, but all of the European countries. Every day, it's like, Germany just put an order in for F-35 fighter jets. All these European countries are increasing their defense spending. The United States never decreases our defense spending. But then the whole oil issue of, cutting off, oil imports from Russia with producers not necessarily stepping up as quickly. There's a couple of good illustrations. If you look at, think about all of the products that use petroleum and oil as an input. It's like, it's everything just about. And so it's a lot of stuff that goes into housing. And so that wasn't necessarily priced in, but now everything that in terms of inflation, and that's not going to, again, it's not going to decrease prices if oil's
and one thing that I think oil, and we'll return to this, but it's like such a complicated system, and it's very globalized. People talk about let's get energy independence, but we're connected throughout the world. We're refining other people's oil and sending it back, and we're combining Russian oil with a bunch of different oil so that we get really good oil in the refinery. There's just all of this,
all this interdependency.
And so even though Russia, and everyone talks about how Russia is a small fraction, energy is is such a huge part of the economy that one little tweak can send things spiraling out of control. It's totally not hard to imagine, something. And I heard somewhere, Russia is about 10% of the oil production in the world.
I think I think 10% of our U.S. import. No, you're right. 10%, production in the world, which is not huge, but it's 10%. Yeah. I think for the United States, it's like 6% of our total. We're producing most of our oil domestically, these days. And I think that the release of the Strategic Petroleum Reserve is going to basically, it's basically going to make up for the lack of imports, but that doesn't change the price. Because the prices are still going up, even if you replace a little bit of the oil.
And the way that these refineries make money, they need that Russian oil too. That's part of their system. And so we're screwing up with their system. That's gotta drive the price.
I'm sure they're figuring it out now, but
even though there's it's the volatility now because it's now oil's in correction territory. But again,
this is why I like multifamily apartments. I can I'm interested in all of the volatility, but I can just sit back and just watch it all happen. And I'm that means rents are all these prices are going up. That means rents are going to go up even more.
So
especially with wages going up.
This is what really got me from the perspective of a multifamily investor. This is what really got me kind of worried, excited, anxious, whatever. Pick your emotion here. I'm thinking about investor. Things are really unpredictable. Inflation is at this point a far gone conclusion. And what do you do to protect yourself? This is it's getting to be this kind of inflation desperation where people are in I don't want to say fight or flight mode, but they're in preservation mode, which is a lot stronger drive than a profit mode. There's a desire for profit, but there's a need for preservation. And what can you do to protect yourself? Where can you go? Where can you put your money? And I think that this multifamily seems like this like light at the end of a tunnel.
Yeah.
And yes, maybe you people could go to gold or to crypto, but it seems like there is so much of a draw there, and as much competition as we've already seen in the multifamily industry, we could see even more people come into it.
Yeah, I think that's the case. We're seeing that. I mean, we're seeing foreign investment, rise, but towards multifamily, and multifamily investment rise domestically as well. And it's kind of weird because you never want to bet against the U.S. economy, and investing in multifamily is not a bet against the U.S. economy. When the U.S. economy does well, multifamily does well. But unlike some other asset classes, I mean, if you want to distill down like the interest of investing into multifamily, besides, housing demand and that inelastic demand and supply demand imbalances, we're shorting the U.S. dollar.
Yeah.
And, we're not saying I want to go short the U.S. dollar because I don't like the United States. It's just, it is a defensive position that has still room for upside. And again, so I've personally, and I'm sure we all have these conflicting feelings of being like, of seeing things happen that we are not going to be beneficial to a lot of people.
Yeah.
Like a war, like inflation.
Mm-hmm.
But the possibility of these events was the driver to invest in multifamily, understanding that there's a possibility.
Yeah.
But then there's still a feeling of like, I don't know. It's like you're betting. It seems like you're betting against the house, or you're betting on the don't pass line in a sense.
That yes, maybe, but also like this is a hedge against inflation. I was thinking about this, like, so you buy, let's just say it's a house. It's just a piece of an asset, like a physical asset that will remain stable as the dollar value increases. So that all it does is remain stable. The value of the house will increase. Or the dollar
decreases. The value of the dollar goes down, but the
value of the dollar decreases. The real estate value stays the same. So really, you're just floating along with it. You're not necessarily taking advantage of it. But I think that what may happen is as more people pile into it, the existing investors are really standing to benefit the most in this position.
Yeah.
I was going to say, like, now's the time to invest, and I'll say the same words later. But really, yesterday and a year ago was the time to invest.
Sure.
But even now, there's room for growth.
Well, like we talk specifically with apartments, there's a little bit of, we've seen the flash before you hear the sound in terms of, inflation and market rent growth. And there's usually like a 12 to 24 month period of trying to get up all the effective rents up to that market rent growth. So it leads to some opportunities. And it's delayed. We can kind of see, all right, what the next couple, maybe year or so will probably look like, not for certain. But again, I feel weird being like seeing an article where it's like there's going to be more inflation and being like, okay, well that's going to directly result for higher returns for multifamily. It's like I don't want to feel good about that, but it was also kind of part of our investment thesis coming home. And it's not like we accidentally stumbled into it also. I mean, go back to watching the video we did like January 2021 when I knew there was going to be inflation. I mean, we said it. It's not a matter of if inflation happened, it's how much
we said it so much we got bored of saying it.
I know, and it's like we're beating a dead horse, but there's new information that comes out every day that directly affects the economy.
And that's why I wanted to talk about it today, is because there does seem to be a qualitative difference, especially with the war. When you add this together, this uncertainty, really, I'm wondering when this kind of desperation is going to enter investors' mindsets.
I think a lot. It is. It's in the public markets, in the stock market. I mean, nuclear war is priced in right now. Just not really, just about. But a lot of these downside things have been completely priced in to the market, and I think some of this uncertainty is going to create some opportunity because I'm hoping it leaves an opportunity to get into multifamily. But as we learned last week, we were bidding on a big portfolio. Mentioned it last week. I'm like, man, maybe someone's going to be on the sidelines with this whole Ukraine thing. Yeah. Not the case. Yeah. More people are interested.
Well,
so it's still
this
competitive.
Is what I wanted to note for before we move on, is that one of the things that multifamily does kind of have going for it, aside from REITs, anyone can buy a REIT, anyone can buy gold, anyone can buy crypto. You can go out and buy that, but you have to have a special set of, special set of skills, some expertise and knowledge that not everyone has in order to put a deal together. In order to participate in a deal, you may probably have to be an accredited investor or have at least like 50 grand for a lot of these apartment syndications. There are barriers to entry, and multifamily is an illiquid it's not traded with as much frequency. So that really kind of insulates it a little bit, and it doesn't make it easy for people to pile into the market as much. Yeah. But even so, I think when the money's there, people will probably find a way to do it.
Yeah. Well, as of, I think, January, $248 billion of dry powder sitting on the sidelines for multifamily. And I don't think that number has gone down.
Yeah.
So speaking of the war in Ukraine, the kind of the horrible invasion from Russia into Ukraine, why do people call it the Ukraine? I don't know.
No, it's Ukraine.
It's Ukraine. I don't know, but why do people say that?
At the same time that people started saying, no, people said the Ukraine, I think, because the United States.
Okay.
And then this is my unscientific theory. And then I think around the same time that people started saying Ukraine, they also started pronouncing Kiev.
And now it's back to Kiev, because then all the Ukrainian people are. It's kind of like it's like an in between.
Okay.
No one was sure like the proper, because I thought the improper pronunciation was Kiev.
Yeah.
But then the proper was Kiev. But then hearing a bunch of Ukrainians that are like Kiev.
Okay, I'm gonna have to.
I'm like, okay. Anyway, Anyway, Ukraine crisis to reverberate across global economy. U.S. real estate positioned to withstand the impacts. And John Chang from Marcus and Millichap has been doing a great job of kind of keeping things in context.
Yeah. This report really pairs well with a research video that he did specifically on the Russian oil ban and its impact on real estate investors. In this study, he leads with the oil prices as this big factor, especially when it comes to inflation. I'd love a quick 5-minute explainer on the major factors behind oil prices, but as I've mentioned before, it's really hard to untangle this. Now, you mentioned before, Spencer, about how U.S. Oil production is there's some capacity there. Yeah. And I do remember, this is part of what I've learned recently, just trying to dip my toe into the subject, that, U.S. produced a whole lot in 2018. I was reading articles that it was one of the highest growing in terms of like global oil production. U.S. grew far and away more than anyone else in 2018. And so what happened, and I can get you, please comment on this and send me angry emails if I'm wrong here. U.S. produced a lot in 2018. The price went down, and it kind of changed the calculation for oil producers and how much money they make between upping oil production or not, because I think that in 2018, they upped production too much. It drove the price of oil down to less profitable.
Well, it went negative during the beginning of the pandemic as demand just, to your point, they were producing a lot of oil, like record amount of oil, which cheap gas, okay. But then demand just, like, everyone stopped driving their car for like a month or two.
Yeah. And now, and I think what is true is it seems like oil producers don't want to produce more when they could just make more money and continue to produce the same amount. Yeah. So there's more risk for them to up production because that might increase. And you see now, oil prices are in that correction territory. And again, like, there's so much volatility that I think that having this consistent oil production is probably favored by oil production. Now, that's not to say that supposedly there's talk of putting the Defense Production Act into action to kind of spur oil production, or some, there's some kind of heavy hand of government that might try. I think that and John Chang notes this in his video, of tapping into the strategic oil reserves, which seems like more of a stopgap solution. Yeah. I think that I could see, instead of, demanding production to happen, there may be a way to encourage and make it profitable at the same time to for oil producers.
Somebody's there. Market's going to figure that thing out. I mean, because it's like, if the prices are so high, like, again,
exactly, that's what I keep thinking about.
Someone's going to be like, oh, I've got some oil on the ground over here. Why aren't I going to plug that? Because everyone thinks, well, I'm going to plug it and drill it and sell it before the price goes down. Mm-hmm. But if you own some oil production property, why wouldn't you?
Up money every day that
you've got, at least somebody's thinking about it. Somebody's going to do it, and then all of a sudden,
And sometimes you see these drops down, and you realize, oh man, I should have sold just yesterday when it was really high. It's not going to get high again. Another thing that John Chang notes in this study, at least, is he talks about positive demographics remain a key factor supporting the housing market as millennials age into the prime rental cohort. So that's one big thing when it comes to commercial real estate specifically.
Yeah. Well, especially when, we anticipate so many millennials buying homes, but they just can't afford to buy a home. And so they're staying renters for longer, while at the same time you've got a whole new generation of renters, the Gen Z generation, that is now looking for a place to rent. They're graduating college. And then baby boomers as well that are filling up some of the apartments as well. And
I'm bleeding over a little bit to the video, but it's and I can kind of summarize it here instead of forcing everyone to watch it. But he makes a good point that it is a fluid situation. Things are changing every day, and
everyone.
And
this week I'm going.
One thing that he does note too is that there are other factors here, and he noted when he talks about positive demographics in the housing market. There's stuff we said this on this newsletter. Is there's stuff happening? It's not all the war in Ukraine. And there are other pressures, especially on oil prices. I was looking into this, and I read an article from Barron's that talks about how on the demand side for oil, fears about an aggressive policy response from Beijing to China's COVID outbreak has raised the prospect of a much weaker demand for oil. So there are factors in oil that maybe could reduce demand, decrease prices, but there's not a single factor in this.
Well, but then we were talking about just before this, so like decreases the demand for oil, but then there's not as much output on the supply side from China, and so it's like, okay, prices go down for oil, but then then the supply chains have additional bottlenecks, and so there's so many variables and inputs. And, Matt, you were talking about trying to figure all this out. And it's like, well, no one's got it figured out.
Yeah.
The only thing we can do is try to look at the situation, gather the right good quality information, and try to, navigate the best we can. But, I mean, Federal Reserve, they don't know. They don't know. Well, nobody knows. No one knows.
And that's really the real upshot of this.
Yeah.
And I wrote down here the upshot is inflation, but no. The real upshot is interest rates. The real upshot is Fed thinking that they really have to do something. And so John Chang says near the end of that video that interest rates will face increased upward pressure, and economic growth in 2022 and 2023 could be slowed. Higher risk of stagflation, but really for investors, especially multifamily investors that are looking to get a good loan on their properties, maybe higher interest rates could make their profit margins a little bit less.
Yeah, no, that is definitely a factor. We are paying attention to really stressing our models up to higher bounds, for using floating rate, making sure we have a cap in place. So, we're just capped at the interest that we can pay. I mean, but that's going to be an attenuator to real estate and further cap rate compression. Yeah. I don't see cap rates like rising too much, although they've like lowered even more than people I think have realized, because now that most transactions are in the low 4s, high 3s, which is crazy to think when we were in mid 5s up to, and we were buying deals for 6 cap yesterday, it seems like. Big deals, newer deals. But if your interest rate, is rising significantly, that's something I can underwrite. I know, but lenders like, this is your spread over whatever base indexed. Mm-hmm. Okay, I can underwrite that. If you're doing a short-term bridge, it's a little bit more difficult to forecast, but on the growth assumptions is very difficult right now, because we know growth is high. We're probably going to be growing rents higher than 3%. Then we've got all this lagging growth that's already occurred, the difference between market rent and effective rents. But then what is the future growth? And all the numbers look like crazy red flag numbers, like that you would never put into a model, you'd be laughed at. I mean, we had a conversation with a large crowdfunding platform yesterday that was interested in investing in some of our projects, and they were like, we're having a hard time getting wrapping our head around some of this organic growth. I'm like, I get it, but this has already happened. Like, we're not making this up. This has already occurred. This is what they're already like. This is the gap that we're seeing today, not factoring in. I'm like, we're not even factoring in additional inflation and growth, which is what we've been talking about right now. And then things have moved so quickly. Mm-hmm. Time has been compressed
and that's part of the anxiety that I was, when we were talking about inflation, is the rapidness, the speed at which it's happening. It's like, you better get in.
You always know in the past, it's like, yeah, we know inflation's going on, but it was at such a low level. I mean, the past 10 years has been sub 2% essentially, that like, yeah, okay, it's going to be, dollars going to be worth less, but just on the margins.
Yeah.
And so I could you sort of assume the same type of expenses. I mean, you would still, like in modeling an apartment acquisition, you still have, an expense inflation assumption, usually 2%. You should use higher than that now. But it was much more like linear and pretty steady. But now it's like, it's grown so much.
Yeah.
And like, we're looking at, it's really difficult because like exit prices on like a price per unit basis are so much more than they are today because there's going to be future growth, and they're so much more than they were last year.
Yeah.
Even the current price per door acquisition prices are mind-boggling. Now, they make sense because of the incomes. You can justify them. They still throw off good cash flow, and then we're factoring in, okay, we're going to see moderate growth for the next year, and then it's going to taper off, and then you're seeing a price per unit, call it 5 years from now, that is really expensive, and it's like, well, we're moving so quickly. Again, this time has been compressed, and so
multifamily is supposed to be the long-term thing. It doesn't. Yeah. You don't have to think.
It's not a get rich. Yeah, I know, but it's like, wow, it happened. It's amazing what happens in a year.
Yeah.
But there's this like time and space displacement of we are thinking about future prices through today's eyes, which if we did that same exercise even 12 months ago, it would be crazy. I mean, we were talking about, cost, replacement cost. Replacement cost is very hard to determine right now. I mean, like we knew of replacement costs in some properties built not too long ago of $100,000 per unit. You no longer can buy there's not that much on the market for $100,000 per unit anymore. I mean, Suncrest, we bought Suncrest for $100,000 a unit last year. And that same type of property would now be trading for $150,000 to $175,000 per door. And if I would have shown an investor, we didn't assume that, but it's like if we would have thought about that last year, we bring into a big sophisticated investor, private equity group, a family office, some of our our larger investors, they would have like laughed at us and called us crazy, and then it's happened. So it's an incredible time to be alive in. And again, just to reiterate, I think the importance of not to toot, our own horn of what we're doing, but I think if you're not consuming the right information at a very high frequency, if you're not, you could be a month behind, a week behind, a quarter behind, and you're living in a different world. Reality.
And this is, that kind of leads into a little bit of my notes on the Yardi Matrix report, because as much as it feels like, wow, it sure did peak, didn't it? As much as it seems like the good times were last year in 2021, going to be a pretty good year in 2022. Maybe not the dizzying highs of 2021, but again, like we said, all of the evidence continues to support the idea it's going to be another record rent growth for the multifamily market for this year, for 2022. I did a little bit of the math. Now, this is moving on to this Yardi Matrix February 2022 report. They recorded a a little over 0.5%, so 0.6% rent growth last month. Now, if you extend this 0.6% out over 12 months, you get a 7.2% rent growth for 2022. Now, February's even a slow month too, so it's probably going to grow even more than 7.2.
Yeah, you usually don't see the increase until March. Yeah. April and June is the peak.
So I, it could easily be 10% rent growth for 2022, and what do you see? What's a typical rent growth number? Is it like 2%?
3.
Yeah, so that's at least double, probably triple. Yeah,
that's what I'm saying. We've had multiple years of growth compressed into like a year.
Yeah,
and now we're having multiple years again compressed into a year.
Yeah. So like I said, I like the one of the now this was on the teaser page, but it said just when it seemed multifamily asking rent had nowhere to go but down, the market defied expectations in February and rose to a new high of 15.4%. So just when you think it's going to be good, it's even better.
Oh, it's incredible. Just look at this national, average rents. I mean, Yeah. So, I mean, February, let's look at February last year. I mean, it had really had not much had happened. It started kind of really, again, March, end of February, I guess, but really March. And it's
where it really accelerates.
Yeah.
Yeah, that's a really good point too. Is February really in March through to March? The gases. The people are still starting to hit.
They don't say here. At least I'm not. And if you're listening on the podcast, basically, national rents February 21 were right at 1,400 basically per month. 1,400 for your monthly rent. We're at 620. We're at 1625.
Yeah, that's 15.4% year-over-year growth, according to Yardies.
Yeah, that's incredible. Now, I'm assuming this is the point I keep making because people still don't get it.
Yeah.
And it's just based on conversations. But so this is market rent growth. This is not like all the rents at the communities and apartments themselves.
Most of people aren't paying that rent.
Most of people aren't paying that rent, but rent very rarely goes down. It's incredibly sticky. Market rents don't usually go down. And so all of this is this 15%. Again, this is the flash that we've seen. We haven't heard the sound. The sound is the actual effective rents that are going to happen. This has already happened. It's a leading indicator of what the next 12 to 24 months are going to hold. And that is why I am incredibly, just bullish in general right now. I mean,
remember
great point. Last year, 2 years ago, the best time to invest. Now is next best thing.
Yeah. And I forget whether it was Fannie Mae or Freddie Mac when we did some studies. We went over some studies in early February.
Oh, yeah.
And one of them they recorded less rent growth in 2021 than 2022 because they were actually measuring actual rents.
Yeah.
Like there's going to be more actual rent growth in 2022 than 2021.
I think so. Just talking to even a lot of very professional large apartment managers and operators, they missed the boat. They weren't subscribed to the Gray Report. Yeah. They weren't subscribed to the newsletter. They weren't watching the YouTube channel, and certainly not subscribed to the podcast.
Yeah.
And even some deals that that I'm in as a limited partner or as a co-GP, and I'm like, why? I'm like, we're like $300 below rent. Like, are we? What are we doing? And it's like, our property managers or regionals just, they didn't realize. And there's there's psychology there of like, oh, I don't want to, that just seems too much. Last year we just raised rents $10. Why would we rent 50 or 100? Seems crazy. Yeah. But it's really just where the market is, and the entire market can move beyond you, and you're really missing out on that. And it's people don't. Again, it's the greedy corporations is what people are accusing of doing this. But it's like this is where the market has already moved. The prices of everything else have increased. What do you expect us to do? Just sit around and file for nonprofit status, I guess. But unless you are, like, why aren't your responsibility is to, your investors to, keep rents at market, work with your resident base to, don't price anybody out. But we got to work with the market, and we're seeing wages rise, which is going to accommodate some of this.
And again, I know I'm repeating myself. Even after 2021, it still seems like now's the time to get in. Now there's still so much more room. We had the promise in 2021. We're really starting to see the benefits now, and there's still more to come. And it seems this is part of why I'm excited and anxious. Is part of why the market is so hot right now is because there's a very short window of opportunity to really realize a lot of gains.
Yeah, it could be longer, but I think like the next 12 months, we talked about this like right now, honestly, even not 12 months, 6 months, because we're going to see that, we're going to May, June, July is going to be here. We're going to see crazy growth. We're going to see prices rise. And like, I'd rather get in, Q1, Q2 of 22 than, Q1 of 23 or Q4 of 22, because the prices and the rents are going to be completely different. Yeah. And when you just see it, just like when, the, $4 trillion of, government stimulus spending during COVID, I'm just thinking, it's weird. I remember the morning, I'm like, literally, I'm in the shower and I'm like just thinking about this. Yeah. And I'm like, And I just had this, this sounds weird, but it's like I had this vision of it's like literal jet fuel just like being like pumped on the ground. It's not being ignited yet because like the economy isn't moving. It's all shut down. But you're going to turn this thing on. It's all going to ignite into inflation. Yeah. And I'm like, I see this going one direction and one direction only. Because the alternative is just like, total financial collapse. And, what are you going to do there? So, again, like nuclear war, what are you going to do? So how do you protect yourself? There's no reason to sell, during a nuclear war, because if it happens, everyone's dead anyway. And there's no one to buy, or what are you going to do with it? Yeah. So, I think it's an incredible opportunity. I mean, I don't imagine we're going to see this opportunity for another, decade or so. I think in this next 10 years is going to be very, very interesting.
Yeah, especially in the next, 6 months. We've mentioned the long-term demographic trends, and that's not even counting in, the rise in millennials and Gen Z renters, or the rise in household formations or anything like that. Really thinking about the short-term aspects of inflation and how people are piling into the multifamily market during the pandemic's recovery. That's really going to move the market significantly.
Yeah, crazy times to be alive. I want to just super briefly, just because I think it's important to look at the reports. And again, if you want to get all these reports sent to your inbox just once a week, GreatCapitalLLC.com/newsletter. We're just going to fill your inbox up just once a week, not like an annoying rate, but like once a week. You're just going to get just solid content and data. You can go to greatreport.com and also see it every day, but that's for people who are really into it and serious investors, I would say. So anyway, so year over year rent growth, all asset classes. This is high end, low end. National average, as you said, Matt, is 15.3%, but on the lifestyle asset classes, the rent growth year over year is 17.6%. And then for renters by necessity, so it's more workforce housing, we're talking about a rent growth a little bit lower, 13.2. That's the metric I'm going to be watching pretty closely as we see those wages in the kind of that bottom or last quartile increase. At least that's what we're seeing on the ground. But let's 15% national year over year rent growth.
One of the things that this report did note was the occupancy is still awful tight.
Yep.
It's still about 96% at this point. And I thought it was kind of interesting. There's some slipping occupancy in some of the hot markets like Phoenix and Las Vegas. It hasn't really curtailed rent growth in those markets, but I think it's still something to watch. And they also, near the end of the report, they talk about the supply and the percent of completions as a percentage of supply, and it's really interesting looking at how there's a sliver in some areas and in others, and especially some of these hot markets, there's a lot of new supply coming online, and I think that could really change the market.
Yeah, I think that changes the market dynamics because there is a ton of supply coming in, especially a handful of markets in the Sun Belt, New York, Los Angeles. Just real quick, Matt, before we move on, just because we're always taking a little bit closer look at our hometown, Indianapolis, Indiana. The Indianapolis is number, what is it? 1, 2, 3, 4, I guess 6, for all asset class rent month over month rent growth. There we go.
That's pretty good. That's not and for lifestyle renters or renters by necessity, I'm sorry, it's number 4. So it's making some really, and so it does seem to jive well with your comments. I think we've talked a little bit about the growth of the industrial market in in Indianapolis. And
that's exactly what I was going to say. I think it's just there's different economic drivers in different markets, and I think that there is ton of growth in the logistics sector in Indy because there's just tons of jobs, and they're all they're all pretty decently paying jobs. Well, so Matt, is there anything else on this report you wanted to?
I just wanted to touch a little bit on. You just scroll past it a little bit. It talks about completions as percent of total stock. Now you see some of these. The highest rent growth is kind of the highest number of completions as a percent of total stock. Austin's number 1 in terms of rent growth and rent expectations. 22% rent growth as of February 2022 since last year, and they're bringing 5.3% of total stock online. 1/20th of it's almost like maybe there's some math equation, but the bringing 5% of total stock online, that seems like a lot. I don't know what the typical numbers are.
That's a lot.
but it seems like a whole lot.
I think the top, and I don't that I've seen recently is Huntsville. I'm trying to find this on this list. Maybe Huntsville's not a big enough market or something, but I think Huntsville is topping the list for at least pipeline construction of existing inventory. I think it's like 12%. But that's an outlier. Nashville, I think, also an outlier, very high.
Yeah.
So these are completion. So these are completions. So this is lagging. So the Huntsville and Nashville, those are. I think that's like permits.
Yeah.
So that's going to be coming online.
Sacramento seems very interesting. It's got a high rent growth, but only 1.3% completions as a percentage of total stock.
Yeah. Very interesting. Anything else on this report? Again, Yari does a great job. Really gets into detail.
No, I just wanted to talk about. I wanted to talk about that because I know we talked about it last week, and I would be remiss if.
100%. So let's talk about keep talking about the Midwest just a little bit. The Sun Belt gets a ton of attention, and you can go a lot of places. We talk about the Sun Belt a lot, and a lot of people are moving into the Sun Belt. There's a lot of investors in the Sun Belt. Some great markets in the Sun Belt. It's a different return profile. You're more speculating on this future growth and upside, a little bit less cash flow.
We talked last week. We talked about that billionaire investor who was dumping $2 billion, half of all of his investments in the Sun Belt markets.
Yep.
He was thinking that they're going to be oversupplied. That's just one investor.
Yeah, one guy.
Big investor, and he probably has a lot of information that I don't have.
Just on that note, talking about Houston, because he was based in Houston, oil prices up, good for Houston. We're not an investor in Houston, but just good on those who are. You kind of live and die by the oil industry. They say not as much anymore, but anyway.
Yeah.
But we like the Midwest. Stability remains hallmark of the Midwest, and
this was a funny report.
Yeah, this is a good report. It's very similar to other Midwest reports and other just in general from the national outlets in terms of talking about different markets. The Midwest is always the most neglected. Matt, you had some good opinions and comments on that.
I don't know how appropriate this is, but
just lay it on.
RealPage wrote this article is 200. I did the word count here. 240 words.
Did you count by hand, or did you copy?
No, I copied pasted. But I did. I did the word count. 240 scant words in this article. And there was another recent article on the Sun Belt, on a Sun Belt renters that was 1,100 words. So that's just a little clue on what RealPage is paying attention to. And you know what? RealPage, fine. You can continue to depict Midwestern states as a boring afterthought.
Do you think they're ceding territory to us in the Great Report? There's like you guys got it covered. Yeah. We don't even want to compete.
That's right.
We're just letting us take care of it.
RealPage, let us do it. We can cover the Midwest. You don't have to.
Just send us the raw shit. Send us the Excel file. Send us the data.
Yeah, we'll take care of it from here. And honestly, it's like, fine, don't notice us. We don't want all these clamoring competition. There is healthy competition. It is liquid. These markets are liquid enough where you can find
and they're growing.
Buyer. So at this point, it's like, fine, don't tell anyone. Leave more for us. That's totally fine.
And this isn't a new phenomenon. Like I was saying, I was at NMHC, National Multifamily Housing Council's annual meeting in 2020, actually, just before the pandemic. And I was participating in their strategies and outlook conference. And yeah, the Midwest was like a side note. Like we're going to talk about the Midwest for just like a quick second. But like hardly ever mentioned it. And I'm just sitting there and I'm like, fine, don't tell anybody about this.
We're good. We're okay.
Like, let us get all this cash flow. Let us get these good deals. Please do not just pile into some of these markets.
Send them to Seattle. Send them to Salt Lake City, to Austin, Boston, Baltimore. That's fine. You can send all that competition over there. We're okay.
Exactly. And again, so what this creates and what excites us about it is it creates inefficiency in the market because everyone's looking left and we're going to go right, zigging when they're zagging, all that fun stuff creates opportunity.
And that's the real. This is why I feel so confident saying this, is because there continue to be people living in all of these cities. Now we have a graph right here for the listeners where it shows a bunch of these different Midwestern cities. Not a bunch. When they're talking about Sunbelt, they actually recorded 19 individually named cities. Now in this graph, they have like 6 or 7 cities, and 3 of them are literally grayed out. Indianapolis, Columbus, and Cincinnati are grayed out for some reason, almost as if to further de-emphasize. But I think maybe grayed out, gray report. They're sending us a message.
That's a really good point, Matt. Yeah, so they've combined Indy. Can't even spell all of Indianapolis or Cincinnati. You could have given its own frickin' line because you've got the information. It would be literally, you've got to put, anyway. Yeah. So yeah, Indianapolis, Columbus, and Cincinnati are all combined because according to them, well, I guess they have the lines, but they're saying they trade together, which I don't disagree with. They have a lot of similarities, but so do all the other Sunbelt markets. They didn't combine those.
Yeah, they're lumping them together. It's what still gives? You can't distinguish Indy, Columbus, and Cincinnati. They're all the same color on this graph because you know what they're like. Who cares?
Yeah,
I care.
We care,
but I don't care that you care. That's fine. I don't care that you don't care. Real page.
Yeah. Well, there's always room for improvement.
Yeah. And this is another good point too, is and I've said this before, is there are still deals out there. As nervous as I was at the beginning of this newsletter talking about inflation and the possibility that so many investors are going to flood the market and make multifamily investments less profitable, there are still places where people aren't noticing things, and one of these could be in Midwestern markets, which, like I said, continue to have people living, breathing, renting apartments, and there's going to be more of them coming up.
And even in the Midwest, I mean, we had an experience. I mean, we again talk about this portfolio bunch that we lost out on, but we at the same time we're bidding on another deal just a little bit north in West Lafayette, which is like an hour away from Indianapolis, college town, home of Purdue University, a lot of economic drivers. You live there you went to school there, Matt.
Not going anywhere.
Again, there's been price appreciation, but it's just not as competitive.
Yeah.
And we're able to, we've got under LOI this awesome, 200 unit, and 2001, 2019 built deal.
And this is when I think of, and I talked about this when we were, when we got the deal, there's all this dry powder, but the people that are
going to the same four markets.
They don't. Yeah, they're going to the same markets, and they just don't have the information. It's like they're not either. They don't have the information, or they're not willing to do the work to look into all the other small markets to search out.
Yeah.
They just can't get the info. And if crowded. You have it, then you're set.
It's becoming a crowded trade to some degree.
Yeah.
Not that there aren't reasons for those markets doing well. I mean, great migration, tax and business friendly. They've got a lot of things going for them. Not to discount that, but you can have a great investment and great thesis, but your timing can be wrong or it can be at the wrong price.
Yeah.
It's
I always think of you think of a market as this kind of this mass of people buying and selling and trading, but ultimately, like when you're going down to an individual deal, now these deals are millions of dollars, so it's no small undertaking, but you're not getting a whole lot. It's not like you're bidding against 100 people. It could be 1 or 2 or 5. Yeah. Ultimately, at the end, it's not a crowded auction house. This is just a smaller handful of people, and they've got things and they've got their own considerations that really make it a very possible thing for you to find a deal. So that's what.
But
really
it's all about it's all statistics and probabilities and making enough attempts.
Yeah.
Because our frequency of offers this year is much higher, and our win ratio is it's probably about the same, but we've gotten more deals because we've put out more offers and we've more conversations, more markets, and so again, like any goal or any problem, it's just a matter of like understanding the amount of effort it's going to require to achieve that goal. And that's what most people miss, is that they look at where they are and what they want to achieve, and they don't quantify the steps that are going it's going to take. And so
what I was thinking is like, if this was like perfectly priced, then it may not be as easy to do this, to kind of wait out the market until and find a deal that meets and really let the numbers play in your favor. But because there are less buyers, it is a little bit less liquid. If you're trying hard enough, you really can't find a deal. And that's been the most encouraging thing to learn about.
And I think there's a lot of like tactical, like surgical opportunities, not to use like buzzwords like that, but like there are some submarkets that or like whole sides of town where you can lump it into this isn't the most attractive side of town. But then there's just like one little area that is like very positive demand drivers. Or it's like, well, if you go a little further that way, there's a ton of jobs. And I'm thinking, what I'm thinking about right now, just, like the east side of Indianapolis, the near east side, not the best. Not the best. You got some crime, you got lower incomes, lower housing prices, stable population, but like it's not like your ideal. We've owned properties there though, and they do great. If you go a little bit further east, it becomes much more suburban. There's there's millions of square feet of industrial under construction. It's pretty blue collar, gray collar, but ton of demand with zero new supply, and it gets lumped in with the entire east side. And so people are like, oh, I don't want to go to the east side, but it's like, well, are you just lumping all of the east side into one category? And it takes that specific market knowledge, which allows you to exploit the inefficiencies in the market. And like, we're picking up a property right now that I think we're buying at steep discount compared to similar aged assets in the Indianapolis market. I mean, up to $80,000 of kind of built-in equity, sort of. But even it's half that. Did I say 40 million, 40,000 or
80,000,
80,000, yeah, 80,000, $80,000 of built-in equity, but even half of that is still, still great on a per unit basis. So it's worth getting granular and focusing on the markets that you really know and finding those opportunities. It's like, I know people investing in New York and people say you can't invest in New York, but then I know people who are doing it. They just know their markets so well and they get in there. And again, it's surgical and tactical and you're not broad base. You can start from a broad standpoint, but you got to kind of get more granular at some point.
Got to live there sometimes.
You got to live there at least time in the market. That is for sure. So Matt, to wrap things up, just to put a book in it, I think there's going to be an announcement from the Federal Reserve, or either I forget if they're meeting today, if they're going to be announcing today. I think they're meeting today and announcing tomorrow.
We got
rate
more.
hike.
Yeah.
Most likely 25 basis points. Will we see more? I mean, that's definitely going to affect the economy. We shall see. We'll see future inflation.
Maybe the Fed just doesn't need to do anything.
That's just, it'd be, what an idea. But then it's like, they've already done it. So like, it's like they broke it. So, or, they're in charge of it. We are here partially because of them. So it's like, well, now you kind of sort of their responsibilities, but, the most important thing is to have the right pieces of information to make the right decisions. That's what we've been dedicated to here on the Gray Report. Again, 3 real ways to stay in touch with the Gray Report. 1, subscribe to the Gray Capital YouTube channel where we're posting Gray Report episodes as well as other useful multifamily content. 2, sign up for the newsletter, graycapitalllc.com/newsletter. 3, the podcast. And I'm amiss. There's a 4th way. Just go to grayreport.com. It's your number one source. It's the number one multifamily intelligence aggregator on the World Wide Web.
If you find a better one, let me know.
Yeah, let us know. I don't know of one that exists. If you are a accredited investor and if you hear what we're saying, you're like, I think this strategy, what they're doing makes sense. Maybe investing in the Midwest, large apartments or cash flow. Again, if you're an accredited investor, just go to gray.fund in your browser. That's going to bring you to the landing page for the Gray Fund. That is the real estate investment fund sponsored by Gray Capital. That, if you've heard about some of the deals we've done under LOI, those are all going into the Gray Fund. So I would check that out. Gray.fund. Again, if you are an accredited investor, it's only open to accredited investors. And it's going to be open for a short time. $100,000 minimum. That's bumping up to $250,000. Relatively soon. I'm going to probably have our first capital call here in the next month or so. So you want to hop on over to gray.fund to learn more and get signed up today. Matt, any closing remarks?
I got nothing. You know what? It is really an exciting time. Like I said, you can pick your emotion, anxiety or excitement. I hope that people are excited. I'd like to be optimistic, and I think that there's a lot of good reasons for people to keep working.
Yeah, I agree. A lot of reasons to be optimistic. A lot of pain in the world that we feel and sympathize with. And I think it's important to keep ear to the ground and one eye out open for the weather.
That's right. Ooh, nice.
Right. Yep. Good old seafaring term, nautical. All right. This has been a wonderful episode. We appreciate you watching us. Like, subscribe, and leave a comment below if you liked what you heard, you didn't like, or if you have a different opinion of us. Always love to hear it. And if there's ever any topics that you want us to cover, just drop them in the comment section below, and that'll go right to the top of our list. All right. We'll catch you next week.